Let's get straight into that second line, why the Goldilocks narrative was a fairy tale. What are you seeing? What is it about the economic mix at the moment?
I mean, the Goldilocks story made a lot of sense prior to the pandemic. But you got to remember what the distinction we try to make between Goldilocks and soft landing. So soft landing is we have decelerating growth, but at the same time decelerating inflation. So that's actually not such a great environment. It's obviously a lot better than a recession, but it's still slowing growth. Whereas at the beginning of this year, we've had this idea that actually you can have 3+% GDP growth at the same time that you have falling inflation. So this idea that you can have stable or improving economic growth, but inflation continuing to decelerate, we just thought that was never credible. And after the non-farm payrolls data on Friday and data since, I think it's put paid to that idea.
So this is really a compelling idea to me, and I was joking that Goldilocks was on life support. You just point out that it's fictional to begin with, but I am curious about, what has to give here? Is it the soft landing aspect, or is it the inflation aspect that it keeps coming down in tandem with ongoing strength in the economy?
Well, I mean, it does seem ultimately growth is going to have to slow, even if the U.S. economy really just refuses to do so. But given that we do believe interest rates are at a restrictive level, how restrictive certainly we can debate all day if you would like to, but they are high. That will eventually slow economic growth. We appreciate the reason that hasn't happened yet is because of all the fiscal stimulus that's been put into the economy. So it's kind of that battle between monetary policy on one hand, fiscal policy on the other. But rates high enough for long enough, U.S. growth will slow. And it also, it's not just that U.S. growth needs to slow. It needs to slow to below trend growth rate, meaning you need to be probably somewhere below 1.75 in order to get inflation back to target. And clearly, we're a long ways from that.
So just walk us through then how this sort of informs your investment thesis, because you're not exactly bearish. I was reading your notes, and it sounds like you're still constructive, but maybe not as constructive, or you think that things are going to slow later. How do you sort of see this changing your view?
Well, I think exactly it's the timing that we're worried about. I mean, we all appreciate monetary policy works with a lag. Clearly, the Fed is not going to be cutting rates anytime soon. So the previous hikes, the current level of interest rates, that's going to continue to slow the economy. And it's just a question, are we going to see a more sudden deceleration at some point later in the year? So we think that's ultimately what's going to be reflected in market prices. So far, what you certainly see in equities is this very sustained, relatively high level of growth, and we don't think that's going to last. And so when you do start to see that deceleration, and then you will have to see, we think, some weakness in equity prices.